We can just start and
Yeah.
We could have screened the song in meanwhile.
Yeah.
I think yes. So Professor Bakshi has joined.
Yeah.
Uh,
Thank you.
Most warm welcome to Professor Omio Bakshi, and most of our participants have already been able to join. So let us start the program. I think a few
Yeah.
others are. I think almost all the participants have joined. So a very good morning to all of you, all the participants, and all the viewers of this podcast on behalf of the All India Bank Officers Confederation. We start today's program with the welcome address by the
Yeah.
President of the All India Bank Officers Confederation, Comrade Murli Soundararajan.
Yeah. Good morning and salutations from All India Bank Officers Confederation. Respected Dr. Amiya Bakshi, Professor Emeritus, Moderator Prasanthij Bose, and a panel of eminent speakers, and General Secretary IBOK, respected Comrade Soumya Datta. It's a great honor and pleasure to welcome all the participants for today's webinar on Bank Nationalization Day, being organized by All India Bank Officers Confederation. 19th July happens to be a day of much significance and jubilation for many of the bank employees, for it is a watershed moment in the history of the Indian banking when the then government, headed by Madam Indira Gandhi, decided to nationalize 14 nationalized banks by a ordinance. Though the ordinance was later challenged and struck up, the government re-promulgated the ordinance and made it as a law. And whatever has happened after the nationalization is a part of the history, the way the country juxtaposed into an economic expansion, the way the GDP has grown over the years, the way these nationalized banks have catered to the role of the nation building, and the way it has provided employment to the aspiring youth of the country is a history to be read and relished. Today, we are in a situation where the government strongly proclaiming that it is not the business of the government to be in the business is methodically trying to undo the good things of the past and had been very skillfully able to plant a mindset among the people that the public sector enterprises and public sector banks are the scourge on the rare financial resources of the country, and they're trying to paint a picture that they can able to generate the resources for the social spending only out of the disinvestment and sale of the public sector enterprises and public sector banks. So it has become very imminent on the part of the right thinking and consciously thinking individuals of the country and intelligentsia included to come to the streets to expose the nefarious designs of the government and the way they had been going ahead in destroying the national assets of the country and splurging the humongous public assets which has been assiduously built over a period of years. In this background, we have now also witnessing rechristened the Planning Commission of India playing a very active role, and whatever the findings are selectively being leaked into the public domain so that it has cast a spell of fear among not only among the employees but among the public at large. In fact, I belong to an institution which is at the receiving end, Indian Overseas Bank, and day in and day out, we are hearing stories of our members trying to contain the fears of the banking public about the impending perils of the privatization, what it means to them, whether their money will be for a run, and so on and so forth. It had been a very difficult time for the people at the public sector banks of the country, for We are to build a public opinion. Like FRDA bill, we had been in the forefront in building a public opinion, which ultimately led the government to withdraw. Likewise, a time has come wherein the bank employees, one of the most intelligentsia among the trade unions of the country, to take upon itself the role of defending the financial integrity of the country. We, All India Bank Officers Confederation, representing more than 83% of the supervisory staff of the banking fraternity, has taken upon the responsibility to build a public opinion against the evil move of the government, against the sinister move of the government, to quell the onslaught, to build a public opinion. In fact, in this, towards this, we have molded a very broad unity among various trade union sector, various intelligentsia, so that everybody is on a common platform, so that our voices are heard in the right perspective, and this mayhem stops earlier, better the earlier, so that whatever the country we have derived, whatever the employment opportunities the socially deprived could derive, be which has been a part of the legacy, which has been part of the present, continue to be for the future generations also. We have taken up a very holy and bounden duty on behalf of the All India Bank Officers Confederation. I welcome the panel of eminent speakers, Partha Pratim Pal, Comrade Prasanna Roy, Sri Ram Kumar, Sri Rajendra Narayan Nag, Sri Rohit Azad, Sri Suhail Chaudhary, Comrade Sri Jiko Dasgupta. I am very confident that the members who have logged right throughout the breadth and length of the country, that today happens to be a very probably one of the useful days of the life, wherein the inputs they derive out of the panel from the discussions from the panelists will serve them in good stead and make them more confident to face with boldness the proposed onslaught and stop that. And to conclude, I would like to recap the one quote from Sri Narayan Haskar, who was the secretary to the Prime Minister of Indira Gandhi. Been taken, but what is important is to intensify our efforts and keep the social goal all along in the forefront. We continue to march on with those clinching lines of Sri Haskar. Thank you, comrades. Thank you. I will once again welcome all of you to the panel discussion, which I am very confident that will be very, very useful, and it will be adding value to our value systems. Jai Hind. Thank you.
We can't hear you, Prasenjit.
Hello,
Comrade Rajan.
Yeah.
Am I audible right now?
Yes, sir.
Yeah. So thank you very much, Comrade Soundarajan, for the welcome address. We move straight ahead with the inaugural address to be delivered by someone who needs very little introduction. We are very fortunate to have Professor Omio Bagchi with us, who has been following the financial sector and the Indian economy for the past over 5 decades now, and he is credited for, among many other things, for writing the history of the State Bank of India. Professor Bagchi has kindly agreed to inaugurate today's online discussion. We are all looking forward to hearing Professor Bagchi's inaugural address. I leave the floor to Professor Bagchi.
Many thanks, Prasenjit. I first of all thank the All India Bank Officers Confederation for inviting me to this very important meeting, and for taking up the challenge of resisting the privatization of banks, which will be harmful to the whole, not just the economy, but to the whole nation, the poor, the middle class, and all of them. banks, India had very rich safeties and margins from before the time of Gautama Buddha. But banking, as we know today, was invented by the Italians, and a bank founded in the 15th century in Siena still operates. The function of banks, as we know today, is twofold. It is first to give some returns for savings of ordinary people, and on the other hand, to allow the investors to bear risk. It is the difference between the interest paid to the depositors and the interest charged to the borrowers that leads to the making of profit of banks. But the investment is always a risky business. So even when banks are run quite honestly, they can collapse because of a change in the external environment. And there is the problem that people don't always understand, that when there is a business cycle boom, there is a competition between the different vendors, and what happens is that they get into more and more risky projects. So if willy-nilly, the capitalist system forces them to take more risks and speculate, and you find that at the end of the boom, when the economy turns down, many banks collapse. So this logic has to be understood, and the only guarantee against people being hurt by that is that there should be a central bank who can regulate the function of the banks well, and uh, in fact, the best guarantee is for the banks to be owned publicly, so that there is no uh, 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 loss to any individual, and it is the whole nation which both bears the loss and gets the gains out of investment activities. The history of colonial India is full of bank failures. Uh, in the 19th century, practically all the banks were founded by the British merchants here. The first big crisis occurred in the from 1829 to around the middle of the 1830s, when there was the agency house crisis. The agency houses of the uh, British merchants also had banking business. For example, Alexander and Company ran the Bank of Hindustan. So when this crisis occurred, the Europeans the British businessmen got away quite lightly, because an Insolvent Debtors Act had been passed in 1828, which more or less exculpated uh, uh, the partners of this bank. There was no limited liability at that time, but the Bengali businessmen, who were the banyans of these particular enterprises, uh, were totally ruined, and some of them were jailed under the law of those times. And bank failures continued to occur in later times also. Some of the most notable failures were that of the uh, Bank of Bombay, which had in fact three government directors, but at the time of the American Civil War, the price of cotton boomed, and these government directors, along with the other directors, then invested in all kinds of fly-by-night projects. And when the boom collapsed, the Bank of Bombay went bankrupt, and it had to be refounded as a new Bank of Bombay. The other notable failures in the 19th century, up to the uh, end of the First World War, also were those of the uh, British-run banks. These were the Oriental Bank Corporation, the Agra Bank, the Arbuthnot and Company, and Alliance Bank of Simla. In the case of Oriental Bank Corporation and Agra Bank, you can say that it was the change in the external environment which led to their collapse. But in the case of Arbuthnot and Company and Alliance Bank of Simla, it was a case of fraudulent transactions made by the British correspondents of Arbuthnot and Company and Alliance Bank of Simla. In the case of Arbuthnot and Company, it was P. McFadden and Company, and in the case of Alliance Bank of Simla, it was Bolton Brothers. This is a lesson for the current government, because the current government not only wants to privatize the banks, but also invite foreign investment as much as possible. And when the foreigners get a controlling stake in these banks, the Reserve Bank of India would have very little regulatory power. In fact, a long way back when Keynes wrote his Indian Currency and Finance in 1913, he had realized that the government of British Indian government had very little control on the exchange banks of those times, because these exchange banks were all headquartered in London. Nearer the motives for nationalizing the banks, as our comrade has already pointed out, by Indira Gandhi in 1969, were twofold. One is that many of the private banks favored particular business groups. The Central Bank of India favored the Tata Group, the United Commercial Bank favored the Birla Group, and so on. And secondly, except for Canara Bank and Sindhi Bank in the south, none of them wanted to extend their branches to small towns and to agriculture particularly. The State Bank of India had already been nationalized in 1956, because the Imperial Bank also dragged its feet in opening branches in important towns or villages. When the banks were national, even before the bank nationalization, there are financial institutions which played a very important role in stimulating private investment in India. There is the Indian Industrial Finance Corporation, there is the ICICI, there is the Industrial Development Bank of India, there is the State Financial Corporation, there is the State Industrial Development Corporations. All these financial institutions which are run by the central government, except in the case of ICICI, there are sovereign participation. They provided cheap loans to private investors. It is on the basis of those loans, in fact, some of the big business houses of today thrive. Today, of course, the ICICI Bank has been already privatized, and the government of India is planning to privatize the IDBI. When the banks were nationalized, they not only provided cheap loans to the big industrialists, but also to small businessmen, and particularly to agriculture. And it was on the basis of cheap loans and countrywide rural branches that the Green Revolution in agriculture was founded. India had faced a famine-like situation in 1965-66, when it had to import 18 million tons of wheat from abroad. If the banks are privatized, and particularly if they get into foreign hands, the big businessmen will benefit definitely, because they will partner the foreign investors. But ordinary people will be ruined, the ordinary customers of the bank, ordinary small businessmen, and most important of all, the food security of the country will be endangered. the there are, although there are large number of failures between 1913 and 1966, something like 1800 small private banks had collapsed. After bank nationalization, there are very few bank failures. Bank failures again started after the uh, neoliberal regime was initiated under Narasimha Rao in 1991. The first important casualty was the National Housing Bank, which collapsed because of the Harshad Mehta scam of the early 1990s. The second one was that of the Global Trust Bank, founded by Ramesh Gelli and initiated with a lot of fanfare by the then Finance Minister, Dr. Manmohan Singh. That bank collapsed within 2 years, and it was absorbed by the Oriental Bank of Commerce. So this was a clear case of private profit at public cost. The most recent failures of banks, you know very well. The latest failure is that of the 94-year-old Lakshmi Vilas Bank in Chennai. But preceding that, there are the failures of IL and FS, Diwan Financial Holdings Limited, and Punjab and Maharashtra cooperative banks. Now, these collapses could have been prevented if the Reserve Bank of India had really acted with foresight and regulated them properly. And as I said, if the banks are fully privatized, and particularly there is every likelihood of many of them becoming controlled by foreign banks, then the fortunes of ordinary Indians will be greatly endangered. So it is not simply in the interest of the employees of the banks or the officers of the banks, but also in the interest of the general public, that we must oppose privatization in every way that we can. Again, I thank you all for giving me the time to address this very important gathering.
Thank you so much, Professor Bachi. Within a very limited time, we have been basically guided through the entire post-independence history of India and the evolution of the banking system and the challenges that confronts the banking system today. And I think that on that note, that what privatization would imply for the future of India's banking and financial system, what would it imply for the interests of the ordinary people, of the ordinary bank customers. Let us kickstart today's discussion with Professor Partho Protim Pal, who joins us from Kolkata. He's a professor of finance in IIM Joka, and I invite Professor Partho Protim Pal as the first speaker of this online roundtable today on whether privatization of banks are in the public interest. Professor Partho Protim Pal.
Thank you, Prasenjit, and thanks, Saibok. I hope I'm audible. Can you hear me, guys?
Yes.
Yeah. So thank you, Aibok, and thanks, Prasenjit, for giving me this opportunity. Just one correction: I am professor of economics, and there is a bit of a turf war. So finance guys may not like it if you say finance. Anyway, after Professor Bagchi's lecture about how the bank nationalization has gone and the characteristics of public sector and private banks and certain historical issues, as he clearly pointed out, I also take the view and I ask us some simple questions. Because of limited time, I'll raise 4 or 5 basic questions about privatization and its benefits, and let us try to see what the evidence and the theory and the empirical evidence says about it. So the first question is about the basic assumption that the private is always better than public. Do we have any conclusive evidence about it? There's a very interesting paper by Stiglitz and Sappington called Privatization, Information and Incentives, where they have pointed out that only under very restrictive assumptions and restrictive uh, set of conditions, privatization will actually lead to any tangible benefits. And they have also made certain very interesting conclusions about privatization and benefits arising out of that. I'll come to that in a moment. However, if we look at more casual observation, if we look at empirical evidence around us, what do we see? We see that State Bank of India, it's a public sector bank, performs fabulously well and competes, sometimes drives out competition from the banking sector. And being a public sector bank, it is performing absolutely well and no complaints at all. On the other hand, we see that among the private sector banks, there are a large number of examples where they have not performed well. Professor Bagchi has given a list of private banks who have not done well and faced number of problems. And remember, the whole notion of bank nationalization was because of the fact that private sector banks were not performing well. And while we say that yes, public sector banks may suffer from certain governance issues, but we must also remember that private sector banks are not also free from these problems. They suffer market failure problems. They suffer problems due to crony capitalism. And if you also look at some of the foreign banks who are supposed to be even more efficient than Indian private sector banks, we have seen Citibank has left the Indian retail banking business few months back, right? So it doesn't mean that ownership will guarantee success or ownership means anything about whether a bank is functioning well or not. So that assumption possibly is not correct. Internationally also, we have seen that the whole notion of too big to fail, that notion has been destroyed after the financial crisis. So just the notion that private sector bank is good and public sector banks are inefficient, so we do not get either theoretical support for that, nor we get any empirical support that ownership matters about the. I mean, ownership can tell you whether something will be successful or not. That we do not get any clear-cut evidence on that. My second point is that what kind of market structure the government is perceiving. If you look at some of the recent developments, that you have seen that the government said that economies of scale is good, and therefore we do not need many public sector banks, or we need to consolidate them. And then the wave of mergers started, and number of banks being put together. Some of the banks who have not been merged, they have been, the Niti Aayog and others have suggested that they will be privatized. Recently, the finance secretary has said that eventually everything will be privatized. He's a smart man. He didn't give a timeline. He said eventually. Eventually, everything will be privatized. So, if you take all these things together, so what are we seeing? Are we seeing that the government is looking at an oligopolistic market structure in the banking system where a few large banks, maybe most of them private and maybe one or two public sector banks will be dominating? Is that a desirable market structure for a sensitive sector like the banking sector? Now, when you just take one step before that, how about the examples about merger? I think IBOC will be able to tell us about how smooth the merger has been and how efficient the merger has been. From anecdotal evidence, when I speak to some of my friends who are associated with some of these merged banks, they said that in spite of the fact that the banks were merged based on the software they use, the transition has not been smooth. So while there are certain advantages of economies of scale, the transition has been rough. It is still not over yet, and its transition is rough and to an extent costly. Now, if you go back to the market structure question, so is the government looking at a market structure of an oligopoly, while there will be few large banks taking advantage of economies of scale and they will be dominating? And we know in economics that market structure and oligopolistic market structure may not be a good idea. And we have seen the examples of telecom sector in India, where we started with large number of players. Gradually, there was consolidation, and now probably you are looking at a situation where even the third company is very much in question whether they will be able to exist or not. The government, the public sector units in that segment have been systematically destroyed. So I won't be surprised if few years down the line we get into a situation where our banking system starts resembling like the telecom sector right now. But is it a good idea? Will that be conducive to the economy? Will that be helpful even to the government? And remember, all that talks about economies of scale, there is also diseconomies of scale, right? And we have seen in case of HDFC Bank, one of the poster boys of private sector banks, that if you become too large too soon, then even then you face a problem, because as you know, RBI has, because of technological problems, not enough investment in technology, RBI has stopped HDFC Bank from doing certain things, and they are still in the process of adjusting. So there is also a diseconomies of scale. Now, coming back to the question of whether this kind of market structure is good enough. If there is a oligopolistic market structure, there is a strong possibility of collusion among the banks. And will that help the governments? One of the points that Stiglitz has mentioned in the paper is that the argues that greater case of intervention, greater ease of intervention on the public ownership gives certain advantages to the government, right? So, for example, you think about some recent government policies, think about Jan Dhan policies, think about loans to the MSME policies, think about the implementation of the demonetization, think about the role of the public sector banks during the COVID crisis, right? Will the government have that kind of leverage if there are few large private sector banks in the economy? Will the monetary policy transmission be easy? Now you can say the bank that you move away from MCLR to external benchmark based lending rate, and consequently what the repo rate will be, you will have to pass that on to the consumers. Once it is private sector driven, they can play with the spread, and the monetary policy transmission may not be easy at all for using the large private sector banks. So is this the kind of market structure the government is looking at? And is it going to be a market structure that is desirable for the economy? I doubt it very much. And also remember that private sector banks are not into social banking. They are banks which go with profit motive. Obviously, they will go with profit motive because they have their shareholders to answer. They go with profit motive. They will be lending only to a niche segment, and consequently, the whole notion of social banking will be completely absent among the private sector banks. So, how is the government going to deal with some of these policy measures? Some of the policy measures which we see are delivered through the banks. For example, if you look at the fiscal incentive that the government has proposed, significant part of the government incentive is through the loan guarantee scheme, where the government is essentially saying that the banks that you give loan, if somebody defaults 2 years, 3 years down the line, I'll repay you. Now, for maybe for public sector banks, there's a pressure to give loans, but will the government be able to exert same kind of pressure towards the private sector banks? Again, I am not very sure at all. The third point that I want to mention is that the public sector banks have certain special characteristics. Okay, and this is important. If you look at the deposits that the public sector banks have generated over the years, and in spite of some of the bad names associated with the public sector banks, especially after the scams and all, the deposit rates didn't come, deposit generation didn't come down. The deposits actually went on quite okay. So there is a significant amount of trust among the general public on the public sector banks. And in spite of the low returns that we are getting these days, in fact, sometimes negative real returns that we expecting these days, deposits did not come down significantly. Right now there is a bit of a problem because the financial condition is not very well, and the Reserve Bank is saying that the savings have gone down, but the deposit generation, because of the bank's image of the public sector banks, have not got affected. And there is a significant segment of the population who trust these banks much more than they trust the private sector banks. And if you look at some of the profile, and with aging population who will be more concerned about the safety of their money rather than generating higher and more maybe risky returns, there will be a place for the public sector banks among the general public. And politically, I don't think it will be very easy to push through the privatization, which the finance secretary is suggesting that everything will be privatized eventually. Another problem we need to understand that why public sector banks do not perform very well is the asset and liability time mismatch, right? While your deposits are long-term deposit and you are fixed on a contractual interest rate, for example, suppose you say that we're going to give you 6% for the next 5 years, your lending rates are variable, and it's variable according to the external benchmark rate, which is the repo rate. So while your cost of funds are kind of locked for a period of time, your income which you get from the lending rate, that's fluctuating, and in an interest rate regime which is going down, this always going to be a pressure on the public sector banks to maintain profitability if they have to pass through the monetary policy, right? If they have to ensure that the monetary policy transmission goes through. And also another area which is very important and where the public sector banks took the brunt and now is suffering is the abolition of the DFIs, the long-term finance, the development finance institution. Professor Bagchi has mentioned about the IDBIs, the ICICIs. The role is being now played by the public sector bank as universal banks to give those long-term loans. And consequently, the mismatch between deposit and lending time mismatch is becoming even stronger. If you see the non-performing assets of the public sector, you will see that most of these the non-performing assets are kind of skewed towards this infrastructure sector where the loan amount is very long time, and probably the public sector banks were not equipped to handle those kind of long duration loans. Another very important point that is raised for privatization of the banks, which Professor Abhijit Banerjee has pointed out, is a policy paralysis. He says that because of the vigilance problem, the threat of the Central Vigilance Commission, there is a policy paralysis among the public sector banks, and therefore they do not take risky loans, etc. They do not give risky loans, etc. And he argued that the government shareholding reduced to below 51%. He may have a point. He's a very learned person. But think about the same problem for the private sector banks. The private sector banks are again, they are answerable to the shareholders, and the quarterly results exert a significant pressure on what kind of loan that you can give to your lenders, right? So there will be also a pressure. It's not that the private sector banks are immune from any kind of pressure, just like the public sector banks are under pressure from the so-called the threat from CVC, as Professor Banerjee has pointed out. So it is not that there is a clear-cut winner in this respect. There are pressures, and there are pressures either coming from the government sector or coming from the private sector. So again, there is no clear winner that we can see. Finally, my last point, I was looking at the ratios. Prashanjit, is it possible to share screen here?
Yes, I think it's possible. You have to, in your screen, I think in the bottom, there would be a screen sharing option, if you can see.
Okay, just let me check. Can you see the screen? Is the
Not
screen
yet.
visible?
Yes.
Is it visible?
Yes.
Yeah. Okay.
Yes.
So this is as you know, the very common statistics. This is the bank group wise select ratios of scheduled commercial bank for the year 2019-20. So it's before COVID struck, right? So you have this reserve. This is by Reserve Bank of India, and you have three ownership wise columns: public sector banks, private sector banks, and foreign banks. I have not taken foreign banks into account. I have just taken the difference between the public sector bank and private sector bank for these different ratios, and they sorted it according to just the magnitude. And on the right hand side, there is a percentage difference as well. Now, if you look at the areas where there is a maximum difference between the public sector bank and private sector bank, you will see that among the first top 5 biggest differences, where the public sector banks are much higher than private sector banks, is in area of wages, right? And if we assume that the average wage in private sector bank is higher than public sector bank, I know there is a problem assuming that because the structure is very different. But if we assume that the average wage in private sector bank is more than public sector bank, then it just shows that there is a possible massive employment impact if the public sector banks are privatized. Just look at this ratio of wage bills to total income in public sector banks is around 14%. It is around 8.69% in private sector banks. Okay, these are averages, and you have kind of multiple banks and of different size. So it's very broad data, broad stroke, but it shows you something that ratio of wage bills to total expense 17.43, 12.32 in private sector banks. On the other hand, if you look down where the private sector banks are much higher, what you see is that what Professor Bagchi was talking about, and I was also talking about, that the motivation of private sector banks is towards higher return on their advances, higher return on their investments, so on and so forth, where the difference is much more, and the private banks have much higher return than many of the public sector banks. And I suspect the lower return of the public sector banks also come in because of the basic motivation of these two type of banks are different. And I strongly believe that there will be place for both. And if the finance secretary says that eventually everything will be privatized, that will be disastrous. So I'll stop here.
Thank you so much to Professor Pal, because I think that he has really opened up a very wide range of issues in terms of the challenges of the contemporary challenges facing the banking sector, and what the implications of privatization can be vis-a-vis the market structure, which will have a direct bearing on bank customers, both the borrowers and the depositors. And what will it mean for monetary policy, what it would mean for the financial system as such. I think that there's a lot of food for thought in what Professor Pal has, the way he has started off the discussion. I think to take it forward, we now invite Professor Ram Kumar, who is joining us from Tata Institute of Social Sciences, Mumbai. A very warm welcome to Professor Ram Kumar, and I hand over the floor to Professor Ram Kumar.
Thank you, Prasenjit. Good morning to everybody. I've just escaped saying good afternoon. Professor Bakchi, comrades in the IBOC, and friends who are in the panel, thank you very much for inviting me to be part of this distinguished panel. Many points have already been mentioned by Professor Bakchi and Partha Pratimpal, but I would sort of maybe some of the points that I mentioned may repeat some of the points that they mentioned. So I would apologize in advance for that. But let's begin with the point. Who is ruling India today? The group ruling party and its predecessor, pre-1980 predecessor, the Janasangh, were those sections of the Indian society which actively opposed bank nationalization in 1969. There were two sections of the Indian polity which were actively opposed to bank nationalization in 1969. One was the section of the Swatantra Party led by Binu Masani and others. The others were the Bharatiya Janasangh, where its leader Balraj Madhok joined Binu Masani in challenging bank nationalization in the Supreme Court of India, and it was a case that went on till 1972 or 73. The Janasangh's leader and Balraj Madhok's protege at that time, Atal Bihari Vajpayee, gave a very long speech in the parliament at that time opposing bank nationalization. So very clearly, the first point to note here is that we have a ruling dispensation which is ideologically opposed to the very idea of bank nationalization. So the fact that they push an agenda of privatization comes as no surprise. What were they defending in 1969 at that time when they opposed bank nationalization? They were defending a system of banking which was completely anarchic and anti-people. What was that? You had between 1950 and 1965 or 66, whichever year you take, you had a sharp decline in the number of bank branches in India. Bank branches were simply closing down. You also had a very sharp fall in bank deposit to GDP ratio. You had the concentration of banking in just 4 or 5 states. In fact, 75% of the bank branches were located in just 5 states of India. You had a very sharp rural-urban difference. Banking was almost exclusively urban. about 87% of the bank credit was given to industry and commerce. In fact, if you see, only 19 crore or 20 crore rupees was given as agricultural credit in thousands of crores of lending portfolio of the banks at that point of time. And the most important issue was the cross ownership between banking and industry. A large number of people, in fact, more than 150 people, were both in the board of directors of banks and the leading industrial houses of that time, which meant that enormous pilfering of public money into private pockets was happening through these cross ownership of banks and industries. So these were the burning problems of the 1950s and 1960s in banking, which ultimately culminated in bank nationalization and which was being actively opposed by the Bharatiya Janasangh at that time. Now, what did nationalization do? We all know what it did, but the most important impact that nationalization had, in my view, was in taking banking to rural areas, taking banking to the farmers. There was a very sharp increase in the number of rural bank branches. In fact, from 1,500 rural branches in 1969 to about 34,000 rural bank branches by 1991. That was an expansion of banking which was unprecedented in any part of the developing world at any point of time in history. That's the first point. The second point is it was not just rural bank branches, there was also enormous flow of credit to farmers, rural laborers, weaker sections of the society, scheduled caste, scheduled tribe households, and so on and so forth. You also had differential interest rate regime, which ensured that interest rates were lower for those sections who cannot afford to pay that kind of interest rate. All of this meant that if you look at the rural credit portfolio, you will see that for every 100 rupees borrowed by a rural household, if only 17 rupees was borrowed from institutional sources in 1962, it became 64 rupees by 1992. This is data from the All India Debt and Investment Survey. This was the phenomenal increase of rural banking that happened in that time. Two features of this policy are very notable. One is that it actively used monetary policy for the purpose of redistribution in the society. That's the first point. The second important point to note here is that there was extraordinary growth of financial intermediation in this period. If you look at the growth of savings rate, the growth of investment rate, and so on, you will see that administering of interest rate in no way reduced savings rate or investment rate that Mackinnon and Shaw would have predicted in 1973. That theory can be completely rejected just on basis of 2 or 3 numbers from the Indian banking context. So very clearly, banking and monetary policy to be used as an instrument for redistribution. Second, the idea of financial intermediation through active public intervention. These are two important broader lessons that come out of nationalization after 1969. But ironically, the financial liberalization of 1991 and after actively pegged the agenda of financial liberalization on these very two aspects. That is, the Narasimham Committee, for example, said that monetary policy should no longer be used as an instrument of redistribution in the society. Only fiscal policy should be used for the purpose of redistribution. The purpose of monetary policy should be actively limited to the purpose of inflation targeting only. That was the first one of the points that they mentioned. The second is there was an enormous attack on public banking and social and development banking based on the theory of financial repression itself, which nationalization itself had proved wrong. So the idea of that if you administer interest rates, savings rate will fall, investment rate will fall, etc., were actively raised as part of propagating the ideology of financial liberalization. So these two ironies marked the entry of financial liberalization into the policy sphere. And what happened after 1991? They did exactly that. They delinked monetary policy from the objectives of redistribution in the society. Administering of interest rates was weakened, though some kind of administering continues to happen through base rates and so on. A lot of it has been deregulated by this time. And two more aspects dominated the discussion during that time. First is the end of development finance and the promotion of universal banking, which Partha Pratim had referred to in his intervention. Also, active promotion of private banks to substitute public banking in this country. So, an active agenda of privatization came out to be propagated as part of this. So, these were three or four very important aspects of financial liberalization. If you look back at the 1990s and after, and if you see this period, I began by talking about the rural sector. You will see that if you compare the All India Debt and Investment Survey of 92, 2002, and 2013, you will very clearly see the one or two important features that emerge out of this data is a sharp fall in the share of commercial banks in rural lending. If it was 64% in 1992 for rural households, you will see that by 2013 it has fallen to 56 or 57%. And the second is the return of the money lender. In fact, only 17 or 18% of the rural credit was given by money lenders in the early 90s. By 2013, you see that up to 32% of rural lending was contributed to by the money lender. So the decline of public banking and the re-entry of the money lender into the rural credit sphere are two important outcomes of this policy of financial liberalization that we are talking about, of which privatization is a very important part. Public banks began to function after the 1990s, were forced to function in the 1990s and after, purely on a commercial basis and not on the basis of the principles of social and development banking of nationalization. This meant that there was enormous pressure on public banks to withdraw from rural areas, to dilute priority sector lending concerns, and so on, which adversely affected agricultural credit and rural credit on the one hand. On the other hand, when private banks came in, they did not have to meet many of the priority sector obligations that public sector banks had to fulfill, which meant that they had a rather easy run in the Indian conditions compared to public sector banks, which were burdened with most of the difficult, non-profitable tasks of the banking sector. So, for example, if you see, privatization became a very important agenda. It has been referred to by both Professor Bagchi and Dr. Parthapratim. The first round of privatizations happened in 1993. Two important banks that came up at that time, ICICI Bank and Global Trust Bank, both are in trouble, for example. ICICI Bank's chairperson is in jail. The issue with Global Trust Bank is well known. The second round saw the entry of non-banking financial companies into the banking sector. That's the time when Kotak Mahindra, Yes Bank, and all came to the Indian context. If you see the third round, which came around 2015 or so, you will see there new banks like IDFC Bank, Bandhan Bank, etc. are entering. So you have a series of 3 or 4 rounds of policy changes, which lead to the entry of increasing number of private banks into the sphere of public banking, and all these were justified on the basis that their performance on corporate governance is much more efficient and transparent compared to public sector banks. The series of scams that we have seen, each scam increasing the fragility of the financial sector in India, each scam leading to an increasing burden on public banks in India is well known for any of us to be reiterated here. But during this time, when the private sector got a very free run in the banking sector, it was the public sector which had to take up the burden of most of the difficult tasks in the banking sphere. For example, their role to keep banking stable during the 2007 financial crisis, their contribution to the agenda of financial inclusion, their contribution to the agenda of the Jan Dhan scheme, their contribution to increasing agricultural credit when doubling of agricultural credit became an agenda, lending to MSMEs as part of the Mudra scheme. All these have been burdened, the public banks have been burdened with most of these schemes. Private banks did not have to take up the burden of many of these obligations. As a result, if you see, even in the latest, the so-called rupees 20 lakh crore package announced by Nirmala Sitharaman last year, there again, most of the burden was taken up by public sector banks. If you see the moratoriums, if you see the MSME moratoriums, RBI data will tell you that it was the urban cooperative banks and the public sector banks and the NBFCs, which had to take up most of the burden of MSME moratoriums. If you take all the moratoriums together, 41% of the outstanding credit of public sector banks comes under the purview of moratoriums, but only 33% of the credit outstanding of private sector banks come under the ambit of moratoriums. So public sector banks have taken up an increasing share of these moratoriums also, if you see in the period of COVID-19. So you basically see that private sector banks had a free run and public sector banks had a very tough run in this period, where they were burdened with enormous responsibilities. Along with this came the crisis of the NPAs. That became like that made the bad situation worse over a period of time. On the one hand, you have more or less the death of long-term development finance in India. Most of the banks which specialized in long-term infrastructure lending were transformed. As part of the bank agenda of universal banking, you basically saw that most of the public sector banks now, which had liabilities which were short-term, were now lending in the long-term. That became a very important contradiction in this period, and that's precisely the reason why, one of the reasons why the NPAs began to really shoot up in the period after 2008 or 2009. The second important policy feature of this period is the declining role of fiscal policy. Even though it was the case that the monetary policy should be delinked from the agendas of redistribution, it became the case that whenever there was a crisis, including, for example, the COVID crisis, fiscal policy was not expansive or countercyclical. Instead, banks were asked to increase lending to substitute for expansionary fiscal policy, which meant that public sector banks had to take up even more burdens compared to private sector banks, and that further led to a deterioration in their financial position. And thus, that's the context in which you see a rise of non-performing assets. What did the government do to respond to this? There was absolutely no help forthcoming in the recapitalization of these banks. Whenever recapitalization was even attempted on paper, it was purely outside the budget and to prepare the ground for a future round of privatization to take place. So the basic agenda has been to drain public sector banks of all vitality to prepare a loss-making sector for sale to the private sector or private banking sector in this period. So you basically also see a bad bank idea coming in, but this bad bank idea primarily is the step one in a privatization program, where you burden the government and public sector banks more with the idea of the bad bank. You take away all the bad assets out and keep only the good assets and sell them to the private sector. So it's a very clear step one in the privatization agenda of the government. As a result, I'll slowly come to the end of my presentation. If you look at the total share of public sector banks in lending, or take the total share of private sector banks in lending in India, the share of private sector banks was only about 19% in 2008 or 2009, which today is 35%. 35% of the total lending today is undertaken by private banks. That's the kind of growth of private sector that you have seen. But because of the increasing burden of non-profitable tasks given to the public sector banks, you see that public sector banks are in loss and private sector banks are running on humongous profits. The latest data will tell you that public sector banks are running a loss in net profit loss of about 26,000 crore, while private sector banks have a profit of 19,000 crore and foreign banks have a profit about 16,000 crore. You will see the same trend if you take return to assets, return to equity, and so on. You will see similar differences across public and private sector banks. Now, this is the context in which we are facing the new thrust of privatization that the government is pushing, and I would. This is where about 10 public sector banks were merged to form just 4 public sector banks. Now the agenda is to privatize Bank of Maharashtra, Bank of India, Indian Overseas Bank, and Central Bank of India in the next round. Now the key point to note here is that the ground is being prepared for a return to the 1950s and 1960s in the banking sphere in India. This round of privatization, including the agenda of selling banks to industrial houses, means that we are going back to the 1950s, where there is going to be enormous stress on people's banking, enormous stress on social banking. There will be increased cross ownerships between industry and banking, which basically will drain all the social content, the pro-people content in the banking policy. And this is something that we all have to join hands to resist with all our might. Thank you very much.
Thank you so much, Professor Ram Kumar, for this extremely enlightening presentation, and so many issues relevant to the interests of the ordinary people have been raised. It's difficult to sum up. I mean, so many important things have been said in terms of the importance of the public sector banks in ensuring access to credit for the rural population, for the farmers, to the present conundrum where we find that the public sector banks are increasingly being pushed to a corner through unprofitable tasks and having to bear the consequences of a delinquent private corporate sector. So let's take the discussion forward with more such insights coming in. I would like to invite Professor Ranjanendra Narayan Nag from St. Xavier's College, Kolkata, Dr. Nag, to make his presentation. Yeah, so Dr. Nag is hand over.
Am I audible, Prosenjit?
Yes, perfectly so.
Perfectly. Okay. Thank you, Prosenjit, for inviting me to participate in this particular discussion, in the panel discussion. In fact, I have planned a kind of presentation or lecture plan as a teacher, and what I thought of saying has already been told. Anyway, so let me begin with certain basic observations before I share a screen. For me, it is a question-mongering exercise, number one. And for me, it is both academic and very deeply political exercise. So I begin with certain observations. My observation one is that the East Asian crisis is essentially a problem of moral hazard and crony capitalism. Observation one. Observation two is that the priority sector lending, the importance of priority sector lending has been diminished ever since introduction of economic reforms. Observation three, the capital structure and the maturity mismatch are common problems for whether the banks are private banks or the banks are public sector banks. And number four is that merger of banks leads to financial oligarchy. And if that be the case, then also it is to be taken, it should not go out of reckoning that merger of banks may increase the shoe leather cost, which we teach at the undergraduate level. That means the transaction cost. Based on that, I would like to begin with some kind of very theoretical exercise. There is a large literature on relation between finance and growth. There are majorly two approaches. One is called the bank-based approach. Other one is called the market-based approach. The bank-based approach and the market-based approach mean this thing, that if we promote public sector banks, then it will contribute to economic development. And there are many arguments involved here. There are a lot of papers. One of the classic papers is Bernanke, Credit in Macroeconomy. There is an alternative approach, that is the stock market development leading to growth. Now, which approach is more relevant in the Indian context, or for that matter in the context of developing countries? For me, and I can elaborate on that later on during the interactive session, that the stock market based approach is essentially a suicidal. It will be a suicidal for the Indian economy, which is very large and heterogeneous. So that one has to understand. Now I will share the screen, just highlight some of the important points which I think important. Just a minute.
It's in the bottom of the screen, the share screen.
No,
option.
no, no, no. Just I'm sharing it. Yeah. So goodbye public sector banks, and we invite economic bankruptcy. First of all, I have already explained the relation between finance and growth, the bank-based and the market-based application, which means the stock market development. Actually, the purpose of the entire privatization process is actually, develop the stock market, and whether the stock market development can actually help inclusive growth. That's a very, open issue and very open-ended issue. In fact, in this context, I may refer to one of the important papers by Professor Mirokit, who explained that why we need a strong, vibrant banking system in which the public sector banks should play most important role. Now, this entire privatization of public sector banks should not be disconnected from the entire process of economic reforms, which Professor Amir Bakshi mentioned right at the outset in his inaugural address. I mean, we have to understand capital account liberalization and disinvestment from the overall process of the economic reforms, the so-called neoliberal policy since 1991, the underlying class dynamics, and of course, the associated structural transformation. Now, why we are reducing the scope of public sector banks? In fact, the roots lie in the crony capitalism. Now, my own take on the matter is that we are reducing public sector banks, which is essentially disinvestment, has a strong fiscal motive. That means we cannot tax the corporate houses, the big corporate houses. We cannot tax the kulaks. So we are selling public assets, public properties, and therefore in the process we are raising funds. But we could have done much better. The central government could have done much better. And in fact, they have lost this possibility of developing a strong, vibrant public sector bank just because, this particular central government has sold itself to the big corporate houses, and that is a big problem. And if that be the case, then there will be a possibility of credit crunch. The credit crunch means that, the flow of credit of the public sector banks to the so-called MSMEs, etc., would be definitely reduced. Now, suppose that the interest rate is fixed. Simple demand-supply logic. Suppose the interest rate is fixed. Now, if the interest rate is fixed and I am reducing the supply of credit to these micro, small, medium enterprises, what they would do? Naturally, they would fall back on the informal credit market. And the interest rate of the informal credit market cannot be determined by the central bank, RBI in particular. And therefore, what would happen is that there will be an increase in the informal interest rate. And that if that be the case, then actually what happens is that the cost of financing working capital or circulating capital increases, which has a disruptive supply side effect. Already COVID-19 has generated adverse supply side effects as well as the demand side effects. Add with the fact that there is a loss of credit, the flow of credit to these particular micro, small, medium enterprises which generate employment. So naturally, the problem would be that this recession that we are going through would be aggravated. And I can easily connect it with the financial accelerator hypothesis. The financial accelerator hypothesis is a very simple thing. Suppose that there is a reduced flow of credit. Then these particular enterprises would suffer. So they would not be able to even repay the loan. And therefore, the net worth of the banks will fall. And if the net worth of the banks will fall, they'll be more reluctant to supply credit. And this financial accelerator, once it is set in motion, would actually prolong the recession. And what could be done? What could be done? I am coming to the issue of the non-performing asset. Now, first of all, the non-performing asset, if it's a problem, suppose it is a problem, yes, it is a problem, then is privatization is a solution, or merger of different public sector banks can address this problem. In fact, the question arises whether the ownership of banks matter. In fact, the volume of credit of public sector banks is substantial, and that cannot be compared with disbursement of credit by private sector banks. And private sector banks are not necessarily efficient. Even I take the simple Pareto principle, then they are not necessarily efficient. They are also subject to failures, the so-called market failure. And there is a lot of historical examples how the private sector banks can actually fail. Therefore, the argument of the Modi government, the central government, is logically illogical. That since we have the public sector banks suffering from the non-performing asset, therefore we sell it out. That's absolutely illogical, because you see the private sector banks might have the same problems, and it has been already discussed. Now, question is that why there is a non-performing asset? We have to understand that the Indian public sector banks are undercapitalized. So there has to be actually the recapitalization. That particular initiative has not been taken. Raghuram Rajan mentioned it, that we have to recapitalize the Indian public sector banks. That has not been done. Actually, it's a strategic default of big corporate houses, absolutely supported, assisted by the political party in power. And this particular issue has been raised by Comrade Gurudas Dasgupta on the floor of parliament. Both Congress and BJP are equally responsible. These particular two political parties are protecting corporate mafias. I am sorry to use this word, corporate mafias. The big corporate houses, for me, organized corporate vandalism. Therefore, accountability of public sector bank is a responsibility of the state. If the state disowns public sector banks, can wash off its hands, then one can only say that the state actually is not doing what it should do, particularly in the current context of pandemic crisis. So as I mentioned earlier, that the central government cannot tax the big corporates, cannot tax kulaks. Therefore, one fiscal method to raise funds, among others, is disinvestment. And if disinvestment, one has to understand that how the government actually is spending. For me, that there are a lot of items of the government expenditure which are absolutely unproductive. It is like the luxury consumption of absentee landlords. So this is broadly the issues that I thought that I should share. And therefore, I would like to conclude by saying that it is now the time to save actually capitalism from the capitalist. And if that cannot be done with serious intent, with sincerity of purpose, then for me, the Minsky moment is round the corner. Thank you.
Thanks a lot to Professor Nag, both for bringing into sharp focus the problem of credit rationing, which may befall especially the small enterprises in the case that one of the major sources of credit in our country is weakened, the public sector banks. And also, I would like to congratulate him for the kind of plain speaking that he has done in terms of the culpability of the dominant political forces of our country of weakening the public sector banking system by unduly favoring big corporates. In that spirit, we will take the discussion forward. We are very grateful to Professor Prashanto Roy, who has agreed to give us some time. And Professor Roy needs no introduction. He's a stalwart academic based in Kolkata, and he's been a political scientist, Professor Emeritus of Sociology. But our main interest is because Professor Roy's current research interest involves bank failures, especially in Bengal, in history, and I think that it certainly carries lessons for the contemporary period and the debate that we are having today on bank privatization. So I'll leave the floor to Professor Roy to talk to relate his research area in terms of the debate we are having today on bank privatization. Professor Roy.
Can you hear me, please? Hello?
Yes, sir. Yes, sir. You're
I'm
audible,
audible?
but you're not visible.
I'm not visible? Why I should be? Okay.
Yeah, you were a while.
Yes.
Now you're visible and audible. Thank you.
Thank you very much. See, I'll obviously be talking in a language which is not the principal language in today's discussion, not being an economist. And I developed the interest in bank failures in Bengal in the between 1940s and 50s, and that probably is the reason why I've been invited to speak. The details of my research of the bank failures in late colonial Bengal are irrelevant here today, at least for one reason, because if I reproduce all the data, then that will probably take all the time. My interest in the banking crisis was in the form of bank runs and liquidation. I wanted to trace it to the greed of fraudulent men at the top of the banks for particularly other people's money, the depositors' money. That was the middle class, particularly its lower segments. In fact, my primary interest related to the victims of their greed, leading to misery of these peoples and defunding of small cooperatives which rendered various welfare to the weaker sections. If you wanted to be quickly connected to my theme, I request you to remember Satyajit Ray's film Mahanagar. The more curious among you may read Narendranath Mitra's Bengali short novel Shahida, the based on bank failure in Bengali literature. There was an immeasurable human cost most economic analysis did not engage with because it was not measurable. And even radical politicians at most paid a lip service, that too in terms of categories like refugees or lower middle class. The suffering individual and his or her family remained outside of the frame of analysis except their income insecurity. The anxieties, agonies, impaired intimacy, family breakdown, and the loss of selfhood due to such invasive banking crisis remained unrecorded. In my research, I wanted to produce as much of record that I could lay my hand on. Banking in Bengal then, it was only under thin regulatory supervision, making financial malpractices easy. With the possibility of denationalization and the reality of increasing political control of the RBI, both being part of major economic policy changes in recent years, the apprehension of return to pre-independence chaos and crisis in banking, thereby making the country's weaker sections already reeling under multiple forms of ill-fare more vulnerable vis-à-vis market forces now more deeply integrated in global capitalism. Needless to say that many of the specifics of the crisis in Bengal between 1940 and 1959, when many banks failed, do not prevail now. But the basics seems to continue and can resurge after possible privatization. These include susceptibility to manipulation of regulatory authority by the ruling class, the media reaching people with clever and enticing advertisements of competing banks, the practice of blaming the clients for lack of financial education in case banks would falter, and the same lack of humanitarian governance. But now there have been changes in level of each. To elaborate, evasion of control by both banks and their politically connected clients has become more pervasive. Manipulation of regulatory authority has become more efficient. With the onset of electronic media, banks' power of seduction of existing and potential clients has increased manifold. Blaming the clients from their wrong decisions to shift their attention away from bank management's wrongdoings has become more sophisticated. States' indifference to clients' sufferings in case of bank failure is apprehended. These adverse possibilities are likely to become more grave with increasingly drastic restriction on freedom of criticism imposed by the soft authoritarian state, all in the name of our nation's integrity and economic development. Populist politics, deceptive show of civility by those who also use repressive laws, political leaders' use of vernacular to project sham intimacy with the socially sinking groups, all confuse commons means capacity for an objective understanding of deepening threats. If you manage a little time to reflect on your deteriorating existential conditions, the time is marked up by providing you the lure of OTT and many more stupefying pleasures via your mobile. A new money culture, EMI, cashless buying, credit cards, making spending look easy, is fast percolating among the low earning groups, thereby exposing them to unthinking financial adventure. Dream merchants, from leaders in power and out of it, to business organizations, to religious leaders, even educational institutions are at work 24/7. What takes place through the advertisement Amadir Amazon is a clever infliction of intimacy with the free market. This is one example only. Moments of designated economic moments of designed economic transition are looked at as opportune times for financial risk-taking, both debt-led suicides among the people pauperized by state policy and bad debts in banks are happening together. The incidence of diversion of large amount of financial resources in the hands of privatized banks to the coffers of the super rich will increase. Funds for public utilities will diminish, and with it, common people's access to various services. When a nation state denationalizes public institutions like bank, it undermines the primacy of the nation which was at the center of the post-colonial project envisaged in the Indian Constitution. This is what all I have to say, and I think economists better render it more accurately. I'll be available if you have a question, but then I'm trying to point out that in the entire discussion, most of the time, the individual becomes an invisible entity, he becomes a statistics. And to me, this is also inhuman economics. Thank you very much.
Thank you, Professor Roy, for a remarkably fresh perspective. I think we should move on with the discussion. And we have with us joining from Delhi, from Jawaharlal Nehru University, Professor Rohit Azad. I would invite Rohit to take the floor.
Thank you, Prashanda. Thanks for giving me this opportunity. A lot has already been said, and especially with Professor Bagchi's lecture, who has the capacity to say a lot in a short period of time. So it's like a capsule on Indian banking history. And the speakers after him, I would actually start with, I was just looking at the comments, which are basically by listeners. And there was one comment which really caught my eye, because most of the others were more in terms of slogans. Somebody called Vinod Tamta, who's asking about the NPAs. And I think that's perhaps the elephant in the room, the context which is being used for privatization. So if I can show just a few slides to put this in context, it may be easier to Just 1 second. I hope you can see the screen.
Not yet.
Not yet. You can't see it?
Not yet. The share option is on the bottom of the
I
screen.
know, I just did that. So share screen. Okay, share screen, then I go to window, then it's still not showing?
No, Rohit, not showing.
Oh, can you just give me a second? I just had a few slides to show on, especially on this issue of NPAs. So if you can just give me a second. I just I don't know whether it would show or not. So let me still go ahead with. Is it still not showing, or was it because on my computer it seems to be showing?
No, we can't see.
You can't see? This technical glitch is always an issue with presentation. So perhaps I should have just kept it without a presentation. But since I put in the effort, I wanted to show a few things, which is to start with on the issue of, let me try it from a PDF. Hopefully that may work. Okay, let me now try this. Stop sharing.
Yes, it works now.
Is it working now?
Yes.
All right. Okay. So sorry about this. I mean, sorry about the glitch at my end. Okay. So on the issue of, as I said, somebody had commented in the section about the issue of NPAs and the context of, after all, it's the public sector banks primarily which were facing the problem of NPAs. And I just wanted to show you the real picture. So on the left, you see the NPAs in the public sector banks. And on the right, you see the NPA in private sector banks. And basically, this green line that you see here is NPA's proportion of gross advances. And what you find is that while it is true that the rise in the NPAs starts taking place around 2007, 8, 9 in the public sector banks, it's not as if that the private sector banks have not had this problem of NPAs. In fact, as you can see from 2014 onwards, the NPAs in private sector banks have also started rising. So yes, it started rising earlier in the public sector banks, but it's not as if the ownership of the banks had anything to do with the issue of NPAs. And a simple thing that you can see is the reason why the NPAs have gone up. One is simply that the credit deposit ratio has risen. So a lot of credit has been given. In fact, if you look at the growth story of the Indian economy, it has primarily been a credit-driven growth. So it's not surprising that you find a rise in the NPAs that is taking place, starting with the public sector banks, but followed by the private sector banks. So as I said, ownership is definitely not the issue here. then the question is, what exactly is the issue? I mean, why did this happen? Obviously, it's not a lecture on NPAs, and we don't have the time. But simply, this is something that we worked on earlier, is the fact that there was a change in the way credit was approached, or the way investment was financed in India. Earlier, you had the development financial institutions playing the role of providing funds for investment projects, and they had a different mechanism. They had a better control in terms of what kind of projects would be financed. They had better expertise. They were in fact created for that purpose, but the decision of the government, the then government, to dismantle the DFIs for all practical purposes except a few remaining, you actually find the annual credit, which is flow to industry and services, falling for the DFIs, obviously because the DFIs were dismantled. You find an exact opposite trend in the public sector banks. So basically, the public sector banks were playing a role that the DFIs were earlier playing. And it was obvious that this would have led to a problem for various reasons. One, of course, that the public sector banks themselves are not equipped to deal with this kind of providing investment funds. And therefore, it is not surprising that whether it is the public sector banks or the private sector banks, the retail bankers were not, or the retail banking is not well equipped to deal with this problem, which is, the maturity mismatch and all that, without going into the technicalities of it. Which means that the source of the NPAs was not the ownership of the banks, but the source of NPAs is the nature of growth in the Indian economy. And the nature of growth, which is driven by credit, which the burden of which fell on the retail banking, is what gave rise to the NPAs. And that being used as the pretext for privatization, as you can see in the previous slide, would actually not solve the problem. The problem needs to be solved somewhere else. About this issue, and this is related to the financial instability, one factor which has already been discussed, but just to come back to it, is the role of finance in investment. And as you know, role of external finance is quite important in a capitalist system, but it also, and this is the work of Minsky, that it also engenders instability by its very nature. Why? Because when you have a boom, when you have profitability rising, you actually have a tendency of the financial system to start taking more risk. And, the risk appetite, so to speak, starts increasing. And as the risk appetite increases, you have a tendency for more and more riskier lending practices by these sources of finance, whether you have a market-based system or you have a bank-based system. Now, if you were to only have private banks doing this, or a market-based system doing it, then it is obvious that the tendency for this kind of a speculation would be much higher, for the simple reason that while the music is playing, and this is something which was exemplified in the United States during the financial crisis, that it is in their interest while the music is playing to make a quick buck. And that tendency can, however, be controlled if you have some control over these lending institutions to, not go the whole hog when it comes to increasing the risk appetite. That's one. The other is there is an immediate conflict of interest. I mean, and the best example, as Ramakumar himself also has mentioned, is the ICICI Videocon example that you have, which was a clear conflict of interest from the lender to the borrower, who happened to also be the partner of the chairperson of the bank. So that's something which is going to become even more important when you have private sectors doing so. Crony capitalism as it exists is going to be further strengthened if this is the direction in which the banking industry goes. Then the question of profit motive. If the banks are driven primarily by profits, and you have, you can say that if there is a regulatory framework, it is equally applicable to all the banks. It does not matter whether it is private or public. But at the same time, one has to think about the possibility of the regulatory framework itself being changed by an oligarchy of private sector banks. So it's not merely that they will have to adhere to the framework. The question is that the framework itself can be changed if primarily the ownership lies in the hands of the private sector banks. The issue of bank failures, it's obvious that public sector banks have the sovereign guarantee, whereas private sector banks don't. So if they have your deposits, one has to be really be scared of losing those deposits if you have bank failures. And last but not the least is the speculative impulses that the private players would have, which would engender financial instability, something which can be controlled in the case of public sector banks. I have just a couple of more points to make, something which has already come up, but an important component being the question of labor. If you look at the public sector, this I in the morning, so if there is a mistake, I'm sorry, but what I'm trying to just show here is the number of employees that you have in public sector banks vis-a-vis the private sector banks, something that Professor Pal also mentioned. You can see that there is a huge difference between the two. For every lakh bank income that is generated, you have about 7.5 workers in public sector and only 5.8 in the private sector. Now, one could turn around and say that this is basically operational inefficiency. And I would like to say the exact opposite. I mean, why should the question of efficiency come at the cost of labor, especially in an economy which is labor abundant and which is facing unemployment? Labor is also a resource, and hence to consider it as an inefficient resource because more people are employed is not necessarily a correct argument to make. Look at the people who are employed in these banks, and the wage share is significantly higher in the case of public sector banks. Those viewers who are also part of the public sector banks would definitely agree with the wage share, as you can see, which is higher, even though it has fallen. It's much higher than the private sector banks. So the working people in these banks get a much better deal when they are in the public sector banks. And also related to this is the question of social representation. Public sector banks have to adhere to reservation policy as well, whereas private sector banks do not, or at least are not bound to. So there are many issues on the question of labor itself. And last point that I wanted to make, which I think Ramakumar has already made, but still just to show, look at the number of rural branches, proportion of rural branches that these two banks have. Private sector only has 20%, and this after the rise that has taken place recently in their share of rural branches with the growth of private sector in the rural areas. It's still only 20%, whereas for public sector banks, it's 32%. Coming to private sector, to priority sector lending, again, public sector banks do a much better job because of the concept of social banking. So all in all, the point that one is trying to make is that public sector banks were not responsible for the NPA crisis that you have. In fact, removing the public sector banks is going to make the problem of social banking, an important component of why public sector banks came into existence in the first place, itself go away with privatization. So thank you. Sorry if I exceeded the time limit because we are nearing the end of the show. But thank you for giving me the opportunity.
Thank you so much, Rohit. And actually, this is being podcasted live both through Facebook and YouTube. We have been getting a lot of enthusiastic comments, and there are a few questions as well. The problem is that I don't know whether we will be having enough time to address those questions. There was one important question addressed to Professor Ramkumar. I don't know whether Ramkumar has a look at it regarding the sustainability of food security and rural banking. So let us see if we have, I think, two more interventions lined up. If we have some time, maybe we will be able to, give some time for answering questions. So if you have questions, please put in the comment box, and we'll see if we can find some time to answer those questions. Next, we'll go to Dr. Shubhanil Chaudhary, who joins us from Kolkata. Shubhanil is from the St. Xavier's University. I leave the floor to Dr. Shubhanil Chaudhary.
Well, thank you, Ravinjit. And thanks to the All India Bank Officers Confederation. I have not joined St. Xavier's University as yet, but yes, I am from the Institute of Development Studies, Kolkata. Let me just begin from where Rohit has left the intervention. And I'm so glad that Rohit has raised this issue immediately before me, because I want to basically focus on what has happened to the NPS. And already Rohit has kind of argued about the nature of the NPA and where is it, has it generated, and both the public as well as the private sector banks have an increasing share of, private sector banks also have an increasing share of NPA over the last few years. Now, one of the big reforms that the government had talked about when Raghuram Rajan was the governor.
Maybe you
and
can
later,
call the next speaker and come back to Shubhanil. Looks like his.
Sorry. Hello.
I think whatever the problem was, it's now fixed. Yeah, please continue.
Okay. Yeah. Sorry. So I was not audible. The initial points I made. Anyway, so yeah. So what I was trying to say is that the IBC, or the Insolvency and Bankruptcy Court, was touted as one of the major banking sector reforms which were supposed to get rid of the NPA problem. And as you know, that the most of the borrowers who have taken the money from the public sector banks or the private sector banks and have not returned the money, which is the root of the NPA problem, most of those borrowers are basically large borrowers. They are the corporate sector of our country. Now, the IBC framework tried to say that the existing bankruptcy framework that was there in India would not generate the bad loans back into the banking system. So a new framework was called IBC framework, in Insolvency and Bankruptcy Court. So my presentation, it's a very short presentation, would be looking into how this IBC framework has kind of happened in terms of how has the IBC framework worked till now. So the first is a very simple graph from the Financial Stability Report of the RBI, which basically looks into the credit growth and the deposit growth for all scheduled commercial banks as well as private banks, foreign banks, and PSBs separately. As you can see that the currently March 21, the growth rate of the credit is one of the lowest that the Indian economy has ever seen. It is 5.4%. To some extent, it was expected because of the pandemic and so on. But even before that, the credit was slowing down in the economy, which many writers, including Rohit and others, have pointed out in their papers. But the deposit growth is also not very high, but the deposit growth is increasing in the public sector banks, while it is higher in the private sector banks. And this is the NPA. I'm not going into the details of this because Rohit has already pointed out. What is striking is that even during the pandemic, according to the RBI's report, the share of gross NPAs in the total advances of the banks is actually coming down. Now, this is slightly, I don't know, maybe later on when the data, more and more data comes out, this will be questioned, because in a situation where the country was in lockdown for many months, how can the NPA recovery be high, or even the credit growth is not growing much faster? So what has happened here is not very clear. And as more and more data comes out from the RBI and other sources, we'll get a better picture. But what has happened to the IBC? Because one of the major arguments has been that, look, the public sector banks are saddled with these NPAs and they should be done away with. So what is the mechanism? The mechanism is that there is this board which calls the financial creditors, the companies, and some other promoters who can either buy off the debt or the company is liquidated and the money proceeds is given to the financial company, which is the main lender. Now, this is the pie graph of all the cases that have been taken up by the IBC till now. There are around 4,356 cases that have been taken up by the IBC till March 21. As you know, that it started from the first quarter of 2017. The law was passed in 2016. So, from this, what is clear that my slides, it seems, are not visible. From this, it's clear that the most of the things that most of the companies that have come under the IBC have actually been liquidated. 48% of that has been resolved through liquidation. That means the company have been sold by breaking down all the assets of the company in bits by pieces, and the proceeds have been given to the creditors. Only 13% has been resolved through the resolution mechanism. Others are pending in review or resolved under 12A clause. 12A clause basically says that the bank and the debtor, they have a mutual agreement and written off the debt by some arrangement. Now, if we look at the claims by the financial institutions up to March 2021, the total claim has been 5,16,000 crores. In and around 5,16,000 crores is the total amount of money that the financial institutions, mostly the public sector banks, claimed from various companies that have been not paid to them. So that amount is 5,16,000 crores, out of which they have managed to get only 39% of the total claims by the financial institutions have been recovered. That is 2,02,617 crores. That is the amount of money that has been recovered. 5,16,000 is the total claim by the financial sector. Only 2 lakh crore has been recovered, which is 39%. But most importantly, the haircut therefore is around 3,13,000 crores. That is the amount of money that has been completely written off from the bank's assets, bank's balance sheet, which they had loaned to the corporate sectors. Most important thing that comes up is that this 39% is also an overestimate, because there have been 2 or 3 major resolution processes, particularly Bhushan Steel and Esat Steel, where the banks recovered almost 80% of the money. And if you leave out just these 2 companies for which resolution was completed, Bhushan Steel and Esat Steel, and then you look at the remaining realization percentage from the other remaining companies, it comes down to around 30%. So Bhushan Steel, Esat Steel are the companies which gave the most money to the creditors, but others have been, the banks have only got around 30%. And there are sectoral variations within this. I am not going into the details, but the basic point is therefore that the IBC is not working. And one of the best example that it is not working is again the Videocon group, which had around 64,000 crore rupees in their debt, and they had an agreement with a subsidiary of the Vedanta group where they bought off the entire Videocon group by paying only around 2,500 crores. And most importantly, what was the logic? The logic given was that if Videocon group was completely liquidated, that is their assets sold off by bits and pieces, then they would have gathered only around 2,500 crores. So if they are giving around 2,900 crores, it is more than the liquidation value. As it has been pointed out by many authors, Videocon actually owns a part of an oil field in India, and the valuation of that oil field itself is higher than the total liquidation value that the assessors or the valuers have arrived at. So therefore, there are 2 kinds of issues that are coming up. One is there is a hint of corruption, there is a hint of insider trading, where the company which is buying the creditor company or the defaulter company, the banks, as well as the company whose assets are being sold or from whom the money is being realized, they are in some kind of underhand settlement, which has been hinted none less by the judges of the NCLT as reported in the media. And the second is that most of these were a part of the debt bubble, which the government forced the public sector banks to take into account. And now those companies are failing and they are not being able to recover their loans. The second process is through liquidation, and liquidation presents even a very bad picture. Around 1,300 companies, 1,277 to be particular, were liquidated to recover the money till March 2021. The total claims of these liquidated companies was even higher. It was around 6.47 lakh crores. And the total valuation of the liquidated companies was only 46,000 crores. So 6 lakh 47,000 crores was the total money that was owed to the banks, and the valuation of the assets after liquidation is only 46,000 crores. So around 6 lakh crores from the liquidated company has just evaporated into thin air from the IBC process. Now, Raghuram Rajan and others are arguing that, you see, some of this money cannot be recovered because these are early days, and the banks should pay some money, some more credit to these companies such that they can recover some of their markets. Some of these companies, for example, power sector and others, have unutilized capacities. But when we are talking about privatization of banks, we must also remember that basically the private banks will also be set up by these corporate sectors only. There was a proposal floated which argued that the corporate sector, the largest corporate sector in the country, actually bidded for a bank license, which was thankfully rejected by the RBI. But no one knows who the private sector banks will come up with. And there will be an oligopoly of a different kind, where not only the number of banks will be less, but there will be actually a merger of industrial capital and banking capital, which will ensure that most of the, what will they do with this money, and this difference of bank and industry might get affected, whereby the entire development of the country will be questioned. The last point I would like to make is 2 points. One, very briefly, about the international experience. How has the recovery of bad loans taken place in countries, let us say USA, UK, Japan, etc.? In USA, it is around 80%. In Japan, more than 90% of the money has been recovered in very short time. In UK, it is around 85%. And in India, as I have already pointed out, it is 39%. And the last point I would like to make is that this entire question of bad banks, and I think Ramkumar has already talked about it, that you see, what is the bad bank? The bad bank is actually proposing that basically there will be a bank which will buy out the bad assets of the other banks. Now, this was an experiment which was done with the IDBI bank, and it failed miserably. The total valuation was 9,000 crores, and the bad bank could not even generate any amount which is near to the amount that was under the NPA. Now, a bad bank, who will run the bad bank? Will it be a public sector enterprise? Will it be a private sector enterprise? Is not very clear. And even Raghuram Rajan's paper also does not give a very convincing answer as to who the bad banks will be, what will be the nature of the bad banks. The point is, and this is the point that I'll end with, that it is the corporate sector which has taken a huge amount of loans from the private public sector banks, and those loans have not been returned. And there are a lot of issues about it. One issue is obviously the slowdown in the economy and all that. Other issue is also about the political interference within the public sector banks and the government pushing the public sector banks towards taking these risky loan propositions, as Rohit has explained in the slide about the DFIs and the public sector banks. And now those very people who have taken the money from the public sector banks and have not returned it will be given the management of these banks. So even from a very simple question of information or a very simple question of basic economics, this doesn't sound convincing at all, because there has to be a mechanism through which this money is recovered independently of whether a public sector bank is privatized or not. But the government is going to privatize these banks under the pretext that the money has not been returned, and most of the buyers that will line up to buy these banks, I'm sure that most of them will be, some of them at least, would be the various entities who had taken the money from the banks. So what is needed is, although the government has done some kind of recapitalization, what is needed is the taxpayer should not be forced to pay the money that the private sector has already taken. What is needed is that the money has to be recovered from the private sector, And these banks, their management and all these things, I'm not going into all this detail. PSBs, there is scope for some improvement, undoubtedly, but privatization will only exacerbate the problem. It will not solve the problem, but only aggravate it, and it will result in the loss of social banking, the private sector lending, and all that, which Rohit, Professor Amio Bakchi, Professor Ramkumar, and Professor Pal has already raised. So I will stop here. Thank you for your attention.
Thanks to Shubhanil for zeroing in on the core injustice involving this bank privatization proposal and handing over the management of public sector banks to precisely those entities who have created this mess in the first place, the mess of the non-performing assets. And I think that while taking that discussion forward, we are now we have two more speakers lined up, and we'll be winding up the discussion following that. So now I invite Dr. Ziko Das Gupta. He teaches economics at Azim Premji University in Bangalore. To invite Ziko to take the floor.
Thanks a lot. Thanks a lot for having me here. The good thing about being the last presenter is that most of the things that need to be said has already been said. So let me focus on few macroeconomic implications of the present move. In fact, let me share the screen. Yeah, is my screen visible to everyone?
Yes.
Okay. Just one. So basically, I will be talking about 4 points. First of all, the specific macroeconomic context under which the bank privatization has been triggered, and this is of course not the first kind of drastic policy changes which the government is undertaking. In the last 1 year or so, there has been drastic changes in the context of the labor policies, in the context of agricultural policies, and now comes the banks. And so the first point about the specific macroeconomic context. The second, some macroeconomic implications. Of course, the macroeconomic implications will be large and diverse. I will be particularly pointing out 2 specific implications of bank privatization. The third, is privatization necessary to increase revenue? Of late, the finance minister, of course, has said this in her budget speech, and different news articles are coming. That the entire move, one of the objectives is to increase the revenue. So is privatization of banks necessary to do that? And last but not the least, what can be done? So starting with the specific context, of course, we are talking about a recession. We are talking about a kind of the extent of recession being historic. But more than that, that is of course obvious. The more important is the nature of the recession. And there are 3 stylized facts which I think is important, not only for the present purpose, but also for the fate of the recovery. The first is the question of weak global demand. If you remember that even in the late 90s, of course, the extent was low when the economy was not doing so well. 2002-3 was associated with massive rise in the global demand, exports, and that has been the case even in some episodes in the 2010s, in the decade of 2010s. That stimulus is gone, and of course there is a possibility with US recovering in the recent future, but nobody knows when that will happen. So weak global demand and the export stimulus is gone. Low investments. Despite massive rise in the profitability of the corporate sector, even during the pandemic, investments has been the growth rate of investment has been negative, and the expectations are low. And so the central stimulus, the central components of demand, which the neoliberal regime relies on, for the economic recovery, all the stimuli are gone, be it the investments, be it the question of exports. Then comes the question of monetary policy, which within the present policy framework are the monetary policy is essentially the exclusive instrument through which the government attempts to increase output. Uh, there have been at least two limitations as far as the monetary policies are concerned. First, of course, has been the downward rigidity in policy rate, with the constraint of placing or setting the domestic interest rate above the foreign interest rate. There has been a floor level below which the interest rate cannot be allowed to fall. And even when, and that's quite visible, that the RBI repo rate would not fall to the extent, for example, to a level which operates in the US perhaps. So there is a downward rigidity of policy rate below a level that policy rate cannot be reduced to increase economic activity. And second, which has been pointed out by different authors, is the problem of broken monetary transmission mechanism. That even when the policy rates are reduced, it doesn't necessarily lead to, it has not led to any change in the market interest rate. In other words, the only policy instrument which the government does have in the context of the present policy framework, that is also extremely limited. Now, in this specific context, what exactly is the implication of the bank privatization? I think there are at least two implications for this. And the first implication pertains to the question of demand. Over the period, the weighted average lending rate of the private banks has been higher than the public sector banks. And this gap has been widening over time, and particularly since 2017-18 onwards. And so other things remaining unchanged, any move towards privatization would have the tendency to increase the average lending rate of the economy and reduce investments, consumption demand, aggregate demand, and output through higher interest rate. And this is particularly in the context where the policy rate no longer can control the market interest rate. So a journey from, so a move from public sector based banking system to a private sector based banking system essentially would be associated with higher interest rate and lower demand. Now, this would have, of course, further implications that at given stock of government debt, it would imply that the debt GDP ratio would go up, precisely because the output would fall at a given stock of debt. Now, if the government attempts to stabilize debt GDP ratio, which it has been doing in the recent period, and it tries to do so by reducing government expenditure at the given interest rate, then of course output and demand would fall further. And this opens up the stability question in two different ways. First of all, in the best come best scenario, the output growth rate falls further. So instead of any recovery, what would perhaps would confront is a scenario of further reduction in demand and output growth rate. But that's only the best scenario, it seems. The worst scenario is that if the reduction in the expenditure growth rate leads to reduction in the output growth rate to such an extent that it again leads to rise in the debt GDP ratio, which again invokes further rise in the expenditure. So a cycle of expenditure reduction and reduction in output growth rate can follow, and that can be a possibility of dynamic stability. And then there is, of course, a question of uncertainty. The moment in the midst of the recession, in the midst of falling output, there's a change in the ownership, the sovereign guarantee is gone with the privatization. There is an entire uncertain environment as far as the financial architecture is concerned. So a move to privatization involves demand side questions. And so that's the first implication. It would have perhaps an ambiguous impact on the level of demand and stability issues. The second issue relates to the question of distribution. This increase in the lending rate may not be uniform across sectors. Now the sector-wise, bank group-wise data is, the last data point would of course be the 2014 data point. But nonetheless, this has been a long-term trend that the lending rate of the agricultural sector and many other sectors has been particularly higher in the private sector banks as compared to the other sectors. So the burden of higher interest rate would not be uniform across sector and would fall particularly in specific sectors like agriculture, like the MSME. So not only one is talking about reduction in the aggregate demand, one is also talking about the burden of that squeeze falling on specific sectors, on specific class of the population, namely the agriculture, namely the MSMEs, namely the small borrowers, all of who would get concessional loans from the public sector banks. So there are demand side implications and there are distributional questions, and both can be associated and would perhaps be associated with reduction in the GDP growth rate, employment, and labor income. Now the question is that is this at all necessary? I mean, of course, why is the government so desperate to do that? I mean, is this at all a necessary route to increase government revenues? And this question has come to the fore precisely because of the budget that the finance minister has, of course, budgeted about 1.75 lakh crores of additional revenue from privatization of public sector banks. But is this necessary? The point remains that the same amount or even higher can be collected from corporate taxes, which has presently fallen to its historic low. The left-hand panel, this one, this gives us the trend in the corporate tax GDP ratio in the entire decade from 2011-12 onwards. As you would see that there has been a drastic decline in the corporate tax GDP ratio from about 3.7% at the beginning of the decade to 2.3%, which is the pandemic year. And the corporate tax GDP ratio has reached its historic low. So the point remains that even at 2021 GDP revised estimate, even at that low level of GDP because of the pandemic, an additional amount of rupees 2.3 lakh crores could have been raised if corporate tax GDP ratio was set at the 2011-12 level. In other words, privatization is not even a necessary condition for increasing revenue. One can increase revenue greater than 1.7 lakh, 5 lakh through the other routes as well. Now comes the simple questions that if not privatization, what can be done? Because there has been, as different authors, different presenters, speakers before me has pointed out, that there has been a problem of balance for different reasons, and particularly the kind of growth trajectory which the Indian economy has followed in the last 2-3 decades. But what can be done about this? The first is, of course, the IBC. The recovery rate of the stressed assets, as Professor Shubham Chaudhary was talking about, has remained consistently low. And of course, stringent measures need to be implemented to recover the stressed assets and the NPAs from willful defaulters. Now, this recovery of loans can relax public sector banks' balance sheet constraints, which would lead to higher credit disbursement to agriculture and MSMEs at the given interest rate. Because it can be noted that particularly from 2015-16 onwards, in the midst of higher NPAs, what has essentially taken the hit is the credit disbursement of the public sector banks to these precise sectors. And the central constraint has been that on one hand, the recovery has been low. In other words, the public sector bank has to tolerate higher NPA on one hand, and on the other hand, the public sector bank has to also follow the Basel norms, the capital adequacy ratios, and other norms of the Basel. So what has been adjusting from the asset side of the public sector banks has been the credit disbursement, and this is precisely the balance sheet constraints of the public sector banks, which different people have been talking about in the recent period. The recovery of loan would certainly help in relaxing the balance sheet constraint and increase the credit disbursement at the given interest rate. So that's one. But the second, there is also a question of aggregate demand, and which is also related to the question of loan recovery. And recovery in demand needs to be an integral strategy for clearing bank balance sheets. Now, the central problem as far as this recovery in demand is concerned is the limitations of the present policy framework, which is termed as the new consensus framework. And in short, this is the exclusive dependence on monetary policy for economic recovery. One is exclusively dependent on the policy rate so that private investments and particularly private investments or consumption expenditure recover in the desired manner, and which, given the with different kinds of rigidities that we initially talked about, has not been the case. So policy rate has not been able to achieve what it was expected to be. The role of state-owned financial institutions become important, particularly in this context, because it gives the government additional policy instrument. It is important for controlling interest rates. Privatization of PSBs not only can have an adverse impact on demand and distribution, it also implies squeeze in the government's policy space to initiate economic recovery, a point which Professor Rohit Razak was also talking about. So the necessary condition to trigger such recovery, economic recovery, by increasing demand, the necessary condition would be to switch to a new macroeconomic policy framework, a policy framework which can be characterized by debt-neutral functional finance regime, where expenditures aim at demand management, while taxes and interest rates are used as instruments for stabilizing the debt-GDP ratio. So what exactly then the central debate boils down to? I believe the central debate boils down to as simple as this: that in the midst of the recession, the question is that what kind of policy framework one adapts, and basically there are two options. One is the option of demand management and fiscal support to labor, or one tries to adopt different measures of ex gratia transfer of resources to compensate profits. The first route necessarily requires changing policy framework, and that includes making corporate taxes and PSBs as policy instruments. The present set of government policies seem to avoid the first route and choose the latter. The central point about bank privatization is, of course, related to the question of the employment question within the banking sector, is, of course, related to the question of the financial stability, is, of course, related to the questions of the entire gamut of issues, but most importantly, perhaps, or equally importantly, is the question of macroeconomic policy framework. By privatization, by implementing a whole set of measures which the government has been doing in the last 1 year, the government is telling us that it will choose not to switch to a new macroeconomic policy framework, but stick to one which does not require making corporate taxes as a policy instrument, or does not require PSB to make as a policy instrument. Thanks.
Thanks to Zico for bringing into sharp focus the larger macroeconomic policy context, and pointing out that that this debate is not happening in isolation vis-a-vis the banking sector, but over the entire set of macroeconomic policies which the government is pursuing. Now, I think that we have almost come to the end of the program, and it gives me enormous pleasure to invite the General Secretary of the AIBOC, who is the main motivation behind this discussion we are having today, as an effort to raise awareness among the ordinary people, among depositors, stakeholders of the banking system, of what is really at stake vis-a-vis this debate. It is not only about the lacks of bank employees and officers, of the few economists and social scientists who do research on the banking sector, but about the millions and millions of people who keep their savings in the banks, in the public sector banks, who borrow from the public sector banks, self-help groups, small farmers, small industries. And I think that someone who has been involved in this movement for a very long time, Comrade Shomo Datto, is the apt person to provide that the perspective from the side of the movement about what is to be done. I leave the floor to the General Secretary of the IBOC, Comrade Shomo Datto. Shomoda, you have to unmute yourself.
Yeah, thank you, Prashanjit. At the very outset, I'd like to place on record our deepest appreciation to all the eminent panelists today. In fact, let me share that we have sent invitations to a number of speakers. one-to-one, many of them have expressed their support for the movement that we have launched, Bank Bachao, Desh Bachao. But at the same time, they expressed their inability to take part in this discussion. Of course, I could suspect that the reason being that this government is averse to dissent. They muzzle the voice of protests. And in this backdrop, all the speakers who have taken part in today's discussion, they have come out openly against the privatization. Myself being the last panelist, I am very happy to note so many incisive discussions regarding criticizing the attempt of the government to privatize the pillars of the Indian economy, the public sector banks. Now, I'll keep my time frame limited to 4 or 5 points. At the very outset, I'd like to touch upon what has been spoken by Zico, that corporate taxes. Why is the need of this sudden urge to raise funds by selling your family silver, the public sector banks? The corporate tax collection has reduced by 2 lakh crore in the last 2 fiscals. And if you see the 2 lakh crore and 1.75 lakh crore earmarked for by selling public sector banks, you can understand that the left-hand side has to match the right-hand side. So it is a clear message to the corporate houses that is those houses which are propping up this government, they have to be repaid. The investment they have put in behind this government, they need, like Shylock, they are demanding their pounds of flesh. This is one. And second, I think Professor Ramakumar has, in fact, I think Professor Parthapratim Pal has highlighted what is the pangs of the mergers. Now, we were faced with the 2 narratives of the government. The narrative floated by the government was during the time of mergers, but why do you need so many banks, so many bank branches? In fact, we were having a discussion with the then Finance Secretary, Sri Rajiv Kumarji. Recently, if you go to this Connaught Place area, within 500 meters, you can come out with 50 nationalized bank branches. Why do you need so many branches? In one building, 4 or 5 bank branches are housed. In fact, I was very surprised. I encountered the same question in a business school in Bangalore, when a young student posed me the same question. Why are you opposing the bank mergers? Because all the banks are doing the same work. Why do we need so many banks? So I had to go back to the preamble, why it all began, how it all started. So after that, but this question we could not successfully, appeal to the masses. But this is one issue I'm certain, not only the bankers, the entire Indian citizenry, they're worried about the safety and security of the deposits. I was going through the list of ordinances and bills. So far, the government has not listed out any bill which will, of course, be seeking an amendment to the Bank Nationalization Act, which is in real terms is the Banking Companies Acquisition and Transfer of Undertakings Act 1970 and 1980. But they have not officially listed this bill. But we all know this government is capable of doing anything. They can introduce a money bill, and they can find circumvent the normal legal structure. Second is now we feel the government is trying to build this FRDI bill in a new avatar. If there are no public sector banks, the question of sovereignty does not arise. If a bank fails, the government will simply wash its responsibility in repaying the depositors. Only the DICGC claim, whatever is the ceiling, the depositors will be entitled for a refund. Above it, it's all in a no man's land. Nobody knows what is going to happen. And secondly, about the mergers, what has happened? It is a deliberate ploy to bring down the number of bank branches. I think Parthapratim Pal has pointed out the technology mismatch. See, even after 2 years of merger between Bank of Baroda, Vijay Bank and Dena Bank, there is still technological glitches that an ordinary customer has. If you are a customer of erstwhile United Bank of India, you will not be able to update your passbook in PNB branch because the technology is different. And if you are applying for an enhancement of a loan, you cannot do it. So there is a flight of business. We have seen when the state bank mergers of associate banks took place, there was a flight of business from the erstwhile associate banks to other banks. other public sector banks, even the private banks. 2 plus 2 does not make 5. That is the synergy that the government is trying to portray, that we are having a synergy, 2 plus 2 will make 5. We have seen in the case of mergers that 2 plus 2 makes 2.5, at best 2.75. Forget about 4, forget about 3. This is the reality that we are facing day in and day out, answering the questions of our depositors, our borrowers, that why suddenly this merger has taken place, has robbed of our basic rights as a customer. So this is the question that we are posing. Tomorrow your deposit will not be safe if the public sector banks are made private. And secondly, another aspect about the professionalism of bank boards. Many of the viewers will be amazed to know that from 2017, none of the public sector banks, they have a single representative, either from the workmen or from the officers as a director, central board director in the bank, who will take part in the discourse when this HR policies are discussed. When this policy, they will be they are supposed to be in the part of the central policy making decision board, but this government does not want dissent. So deliberately they have not been. They are not being appointing any single officer or workman director, so that any sort of dissent is avoided. And whatever goes behind in the four walls of the room are not made public. When this bank merger proposals came, we wrote to each and every individual board of director to kindly resist your opposition to this draconian decision of merger. Our mails were only, we got one reply from one board of director who said that I was not aware of the implications. So this is the feedback of the bank's board. The stooges that the government the directors are being appointed, they are also responsible for the fiasco. If there are financial irregularities, if there are bad loans, there are NPS, RBI nominees are equally responsible, government nominees are equally responsible for any credit decision that has taken place in the bank's board. Let us make this abundantly clear. They cannot just shrug off their responsibility and they are giving the public sector banks a bad name. It cannot be held so. Let us make it abundantly clear. Thirdly, I think Zico has pointed out to bad bank. We are not clear that whether the bank bad will be the ambit of RTI, right to information. Whatever dealings are happening in the so-called bad bank, will it be made known to the public? That is a question we want to pose. It will bound to, there is bound to be corruption when a company which has gone bad, which is a willful defaulter, or even the RBI is not publishing the list of willful defaulters, because they feel if the list of defaulters are published or willful defaulter, it will be bad for the climate, industrial climate. We only know about, the common public knows about only a few Nirav Modis, Mehul Choksis and Vijay Malias. Hundreds of such Nirav Modis and Mehul Choksis have fled the country right under the nose of this government during the last 5-6 years. What has the government done to recover monies from them? That is a basic question. And the next point which I'd like to highlight, much talk about this financial inclusion. I think AIBC conducted a survey 4 years back, when empirically we had it proved in the name of financial inclusion, the common people, the poor people, the rural folk, they are being charged extra for getting basic banking services from the customer service points or the business correspondents. They're literally fleecing this innocent rural citizenry, the poor people, the rural folk. They have to shell out more for getting basic banking service, for depositing money, for withdrawing money, for updating passbook. They have to shell out money to the kiosks, to the business correspondents. And we all know what is happening in the microfinance area, how much of interest they are being charged for the self-help groups or the rural poor. I think many panels have known that institutional credit has come down in the rural areas. They have been substituted once again in the pre-nationalization era, where the money lenders used to rule the roost. And we will be getting money lenders in the new avatar, in the name of fintech companies, in avatars of NBFCs, fintech companies, this so-called private sector banks. Even the small finance banks could make a huge dent into that particular domain which was dominated by public sector banks and regional rural banks, which used to ensure that credit reached at a subsidized rate to the hands of the poor, rural citizenry, the artisans, the small and medium enterprises. And these are the segment that really changed the shape of India's progress, made India self-reliant. Let us not forget the role played by the public sector banks and the regional rural banks. Lastly, talking about employment, we all know that railways and banks have always provided maximum employment to the youth. Particularly, there is reservation as per social justice for the SC, STs and OBCs. What will happen to those particular category? Are we doing away with social justice and denying the people of the country the rights enshrined in our holy constitution? So these are the questions we like to pose, and we are very happy that today all of you have spoken in support of the movement Bank Bachao Desh Bachao. At the end of the program, we have brought out a theme song that can touch, that can express ourselves, what we want to project, that it will be a people's movement. We want to make the government aware that there will be a people's resistance this time if the public sector banks are privatized. Once again, I rest my case, and once again, I profusely thank on my personal behalf and on behalf of All India Bank Officers Confederation to all the eminent panelists, particularly to Prosenjit, the moderator of today's program, the technical support team, Avin and others who have been doing a splendid job in taking forward this movement, providing all the technical and logistical support. Thank you all.
Many thanks to Shomoda, and actually many of the panelists are interested. If the viewers, I mean, we still think that around 50 odd people are watching live. So if there are questions, the panelists would like to address some of them. So while, as Shomoda said, we would like to listen to the theme song of the Bank Bachao Desh Bachao right now. While the theme song is being played, we request all those who are watching this program live to please post your questions in the comment section if there are any, and the panelists would like to address some of those questions if they come. In the meantime, please play the song so that we can listen to the song, and while we are listening to it, the questions can also come.
बचाए देश बचाए जन जन का यह नारा हो, बचाए देश जन जन का यह नारा हो, इंकलाब की जले मशाले शर्मिंदा अंधियारा हो, इंकलाब की जले मशाले शर्मिंदा अंधियारा हो, बैंक बचाए देश बचाए। बचाए देश बचाए चिड़िया चुग जाएगी दाना फिर भाई पछताओगे तुम देश बिका तब मौन खड़े इतिहास को क्या बतलाओगे तुम मिल कर गाए गीत वो संग में मिल कर गाए गीत वो संग में जिसे वतन यह प्यारा हो इंकलाब की चले मशाले शर्मिंदा अंधियारा हो बैंक बचाए देश बचाए बैंक बचाए देश बचाए बैंक बचाए देश बचाए बैंक बचाए देश बचाए बैंक बचाए देश बचाए
So it's a really very well composed song, very apt for the occasion. So we have a few questions. Let me just read them out, and it's addressed to some specific panelists. So Prodipto Thakurta has asked, I repeat my question to Professor Ramkumar. If rural lending, so vital for ensuring food security of the country, is so unprofitable and burdensome, how can it be sustainable?
Well, the only issue with that question is that it assumes that rural lending is loss making. I never said that, and it is not so. Because the interest rates in rural credit are slightly lower than other interest rates, the returns from a rural loan would be relatively less than a return from a non-agricultural loan. That's all. So it is not loss making to begin with. It's not true to assume so. Now, that's precisely the purpose of social and development banking, that even if returns are slightly lower in a relative sense compared to another more commercial or more profitable or more interesting form of investment that you might want to make with your advances, it's still fine because it benefits the country and the economy overall. That's the whole purpose of banking, being used as an instrument of progressive public policy, rather than making it an instrument of private profiteering. So the whole question is, it is sustainable even now. Rural lending is profitable. Rural banks are profitable. It is just that they are not as profitable as a metropolitan branch maybe. That's fine. I don't think that's a problem. So that's my quick answer to that question.
Thanks, Ramkumar. Orijit Hajra asks, in the eventuality of a bank failure, rupees 5 lakh, is rupees 5 lakh supposed to be insured? I think he is asking the question in the context of the new legislation that is supposed to come, which increases the deposit insurance threshold of the banking system. So is that sacrosanct or only on paper? If someone has 10 lakh savings, will he then need to keep 5 lakh each in two different bank accounts to protect his savings? So basically, it's a question on whether the increase in the deposit insurance threshold is sufficient. Any panelists who would like to take this question?
I think.
Well, let me just respond to it. I think that it's a fair question. I think that if you look at the average deposits in our country, especially after the opening of the Janman Yojana accounts, I think 5 lakh actually is a pretty substantive increase. Right now it is 1 lakh. So increasing it to 5 lakh is a sort of increase. If you say is it enough? Yes, it's not enough. I think if you go by global standards, I think it's still quite less. I remember when the FRDI bill had come, when the AIBOC had spearheaded the protests against the FRDI bill, the demands that were being raised from bank customers was to take it to around 10 lakh. So I think that would be a fairer kind of deposit insurance amount. But let me make the point here that seen in the context of the bank privatization debate, let us remember that there is no bigger insurance to your deposits than the sovereign guarantee that is provided by the government behind public sector banks. That's the biggest deposit insurance that you can have. I suspect that the deposit insurance threshold is being increased today just on the eve of the bank privatization move. The government will bring legislation to amend the bank nationalization laws. It's a bitter pill, so they are sweetening the bitter pill by increasing the threshold of the deposit insurance. So I think it needs to be taken with a pinch of salt, because if it is the question of, we are increasing the threshold, then we'll privatize the bank, then they will do more damage to deposit insurance or to the overall interest of deposit security in our country by privatizing public sector banks than by increasing the threshold of deposit insurance. There is a question from Shoumitra Banerjee. Is our government really interested in favor of a robust economy with a structurally sound banking system? Because we can see the malfunctioning of the reforms being brought by the government, example IBC, bank privatization, etc. So it's a question on the on the general intentions of the government. Any of the panelists? Rohit, would you like to take this one? Is our government really interested in favor of a robust economy with a structurally sound banking system? That's the question.
The government has already shown it in its track record in the last, since 2014, what it wants to do with the economy. So suddenly, for the government to change its position in trying to revive the economy is not going to happen. This pandemic is merely, the slowdown had happened, or I shouldn't say had happened, the slowdown had been imposed by the wrong policies of this government much ahead of this COVID crisis. So this is going to just additionally add to the problem, as Zico also said, exacerbate the problem rather than solving it. So, intentions are quite clear. They just cannot handle the economy, and that's what shows in this policy as well.
I think that there is just one more question. It's regarding why are the private banks reluctant to open Jan Dhan Yojana accounts? Anyone? Shubhanil, would you like to address this one? Why do you think the private banks do not open Jan Dhan Yojana accounts the way the public sector banks do?
Well, when you are opening a Jan Dhan account, it's basically very low balance accounts, and there is a cost to the bank for maintaining those accounts in terms of opening those deposits. And on the other hand, those who are opening the accounts, the chance of them taking a heavy loan from those banks is very less. So private sector banks are completely motivated by the profit motive. So what they want to do is that they want to take cheap deposits and then lend it to the customers. But in the case of Jan Dhan accounts, the deposits are not very high. There is a cost of opening those deposits which the banks have to incur, because they can be zero deposit accounts. On the other hand, those people who are making those deposits, they are not the ones who are going to take the loans. So in that sense, Jan Dhan accounts are actually a drain on the banking resources, which again strengthens the point that if you want to have social banking and have financial inclusion, then the private sector banks are not interested. It has to be the public sector banks who will take that responsibility.
If I can supplement. See, there's a clear division. The approach is almost dividing the country into like caste, creed, and religion. The private banks, they clearly demarcate the haves and have-nots. If you cannot open a normal basic banking account in X private bank if the minimum balance is not 25,000, even in the rural and semi-urban areas. So there's a clear demarcation, clear division. You see the government schemes. See this Pradhan Mantri Swanidhi scheme, much hyped Swanidhi scheme. More than 95% of the schemes were implemented by private public sector banks. In Uttar Pradesh, the Dasera leave was under NI Act, it was cancelled because the public sector banks had to fulfill the target given by the government. So this is the real scenario. It's a clear division which is not enshrined in our constitution. It's denying people of their basic rights, constitutional rights.
Prashanjit, can I come in for?
Yeah, Partha, why don't you?
Prashanjit, can I make one or two quick comments?
Sure. Go ahead.
Ranjan here. First of all, I mean, just let me tell you one thing.
You are not visible. You are audible.
Oh, surely. Okay. First of all, let me tell you, I don't agree with you regarding the limit to the deposits. There should not be any limit to the amount of deposits. 5 lakh, 10 lakh doesn't matter. I am a deposit holder. I am putting my deposits in a banks. Whatever be the amount, I have to be insured. And that is the role of RBI as the lender of the last resort. Number one. Number two, a question was asked related to the rural banking and all that. First of all, the institutional credit to the rural sector has not been adequate. Why I am saying so? Irrespective of the recent move in the direction of privatization, the simple explanation is this: what about the amount of informal credit in the rural sector? It has been substantial amount. If you go to villages, you can understand. You go to Bangalore or Canning, you can understand. So that much I can tell you, and that leads to a extensive literature on interlocking of markets in the context of the rural sector. And finally, what I would like to say in a broader context, in a broader socio-economic and cultural context, the cultural context has been talked about by Shomboda. The context is this: in a broader socio-political, cultural and economic context. Society, polity and economy are not isolated elements. This government, the BJP government, has been organizing and efficiently executing planned murder of our society. Of the so-called, this song is very apt song in the current context. And the recent example is Stan Swami. That's it.
Thank you, Rajendra. Partha, I just wanted to point out about one question which you may address, and then whatever else you want to say in terms of concluding remarks. There is one question by Mr. Vijay Raghavan, who is saying whether investing in the bad bank, whether it's going to free up capital for the public sector banks to give out loans, or whether they will tie up capital in an area that is not their core expertise. Whether it's a good idea from an efficiency point of view. The bad bank proposal.
We do not know the modalities, right, of the bad bank. I mean, we just know the concept, and it's basically going to play the similar role as the ARCs. But without knowing the modalities, it will be difficult to say whether it's going to be a good idea, bad idea, because absolutely no clue about how it's going to function. What I wanted to say is to Arijit's question that it is. If you want to ensure your more money, you put the money across different banks, not different branches, because deposit insurance is aggregated within one branch across all the branches, but for different banks you get different ceilings. So 5 lakhs in different banks will get you insured for 10 lakhs. So 2 different banks. So there is an RBI FAQ on this, and you can have a look. I cannot post it here, so otherwise I could have posted. Can I post it somewhere? I'll post in the private chat if Prashanjit can post it in
if it is a link, you can post it in the comment section of the Facebook.
I'll post it in the private chat, but I cannot post in the comment side. So
okay, I think this can be done. This can be posted in the comment section of the Facebook.
This is where the details are given about the deposit insurance scheme. And banks, basically, it is guaranteed because banks pay an insurance premium for these, and the insurance premium for the banks went up like 5 times when the deposit insurance went up from 1 lakh to 5 lakhs. Okay, so it is rest assured that money you are going to get. So that's it. That is what I wanted to say. Thank you.
So that's what I think is the response to Ranjan Das question as well, that if you want to give 100% deposit insurance, then who pays the premium? Anyway, I think that we have had a very lively, although a very lengthy, but a very lively discussion today. And we thank all the panelists who have really taken time out on a Sunday to deliberate and enlighten us on a very wide range of issues which have been covered in today's discussion. I think that those who have listened to the discussion or will be listening in through the social media in future, they will certainly gain insights. I especially request the government, the policymakers, the government of the day to listen to this discussion, to understand that it's not only in terms of some specific group interest that one is holding this view against privatization of public sector banks, but for the sake of the all the stakeholders of the banking system, and which is an overwhelming majority of the people of our country. So it is in the national interest that the public sector banks are kept in the public sector. Yes, certainly they need improvement, but that improvement has to be without compromising on the public sector character of those banks, because they are special. They are special because banking is special. Banking did not be all about making money, making profits for rich people. Banking needs to reach to the overwhelming, the vast majority of the ordinary poor people of our country, the farmers, the small borrowers, the MSMEs, and the self-help groups, the socially deprived sections, marginalized sections. They are the ones who trust the public sector banks with their deposits. They are the ones who depend on the public sector bank credit for their livelihoods, and it is for their sake primarily, and for the overall integrity of our financial system, that we need to strengthen, not weaken or do away with public sector banks. I think that's the common message which has emerged from today's discussion. We hope that the government realizes this, it sees reason, and we do not have to see a reversal of the bank nationalization policies in the forthcoming session of Parliament. As you all know that the session starts tomorrow. Tomorrow is also the anniversary, the 72nd anniversary of the bank nationalization. Bank nationalization ordinance was passed on the midnight of 19th July. Tomorrow is 19th July. Another Parliament session starts the 52 years after bank nationalization. So we just hope that it is not reversed in this forthcoming Parliament session. If it does, I'm sure that organizations like the AIBOC, which are vigilant in public interest, they will certainly stand up and resist such retrograde policies by this government. We should raise awareness, all of us who have our stakes in the banking system, both from an intellectual point of view as well as stakeholders within the economy as well. I think that it's all our task to take this message all over the country, to stand in defense of the public sector at a time when the government, which is its owner, is not doing its duty in preserving and protecting the public sector in the way it should. So we hope that in the days to come, our efforts will bear fruit. The public sector will get strengthened, it will improve, it will continue in a more improved capacity to play the role that it has been playing in the development of our national economy. Thank you so much, all of you who have viewed, who have participated, who have shared their views in this platform today. We hope we can have more such programs in the days to come. Thank you all once again.